14 weeks. That's how long 3 separate refineries are now quoting for delivery on standard product forms. 90 days ago? 6 weeks. If you work in industrial procurement, you already know what that means. For everyone else, I'm going to walk you through why this matters, and why the explanation you're seeing in mainstream coverage doesn't match what's actually happening in physical markets. Let's start with basics. A delivery window is a refinery's promise. Order today, receive product in X weeks. That time frame reflects 3 things: available feedstock inventory, processing capacity, and existing order backlog. When a delivery window doubles, something in that equation changed. And when it happens simultaneously across multiple facilities in different regions, the variable that changed is upstream, not at the refinery level. Here's how industrial sourcing works in commodity markets. This isn't like buying coins from a dealer. A solar panel manufacturer needs 50,000 ounces per month, consistent delivery, predictable pricing, guaranteed availability. They don't spot buy, they contract. They approach a refinery 6 to 12 months in advance and say, we need X volume per month for the next year. What can you commit to? The refinery evaluates their supply pipeline, their processing schedule, their existing commitments. Then they quote a delivery window and a premium over benchmark pricing. That premium is what's changed. 40 to 60% increase in 90 days depending on form and destination. But here's what doesn't add up. Benchmark reference prices, they haven't moved proportionally. You're seeing substantial premium increases for physical delivery, while quoted reference prices stay relatively stable. In normally functioning markets, that doesn't persist. High physical premiums signal profit opportunity, new supply enters, prices adjust, premiums compress. That's not happening. The spread is staying wide, and when normal market correction mechanisms don't engage within expected timeframes, you have to ask what's preventing arbitrage from functioning. There are 3 structural explanations. Supply disruption at primary production. If mined output falls below industrial consumption rates, refineries draw down existing feedstock while waiting for restocking. Extended delivery windows would follow naturally. Unexpected demand acceleration. Industrial consumption is typically predictable. Production runs are scheduled quarters ahead. But if a new application scales faster than anticipated, it absorbs available supply before production adjusts. Geographic inventory repositioning. If physical metal is moving from traditional storage locations to new demand centers, you get temporary unavailability during transit. So which is it? Let's look at trade flow data. According to publicly available customs documentation, shipments from Western refining hubs to East Asian ports increased 37% year over year, most recent reporting period. That's not modeling, that's not projection, that's actual tonnage that cleared customs and moved. Simultaneously monitored warehouse inventory, facilities that publish daily stock levels, declined 18% over the same window. So you have metal leaving documented storage, moving toward regions with expanding industrial demand, creating temporary supply constraints in origin markets. That explains the delivery window extensions. Available inventory has already been allocated to contracts negotiated months ago. It's in transit. Why does this matter beyond supply chain mechanics? Because commodity pricing depends on functional arbitrage. When physical trades at a premium to benchmark pricing, that gap should attract arbitrage capital. Buy the cheaper benchmark contract, take delivery, sell the physical at premium, capture the spread. That process keeps prices aligned. It's the mechanism that prevents sustained discrepancies. But when available inventory is already committed, already allocated to industrial contracts, already in transit, there's nothing for arbitrage traders to access. They can buy the contract. But delivery? They're joining a 14-week queue. This pattern has precedent. Early 2000s copper market. Asian manufacturing capacity expanded rapidly. Mine production was increasing, but refining capacity couldn't keep pace. Multi-month delivery delays became standard. The bottleneck was processing infrastructure. New refineries took years to come online. 2016 through 2018 lithium market. Battery manufacturers faced extended delivery windows despite abundant lithium reserves. The constraint wasn't mining, it was conversion capacity. Turning raw lithium into battery-grade material requires specialized facilities, years to build, billions in capital. The pattern repeats. When demand composition shifts faster than supply infrastructure adapts, you get temporary dislocations. Physical availability lags theoretical supply. Quick note: if this kind of structural breakdown is valuable to you, subscribing helps you catch these analyses when market mechanics shift. I focus on how systems function rather than where prices are headed. Understanding mechanisms beats guessing direction. How does this resolve? Several possible paths. Mining output expands to meet demand. Typical timeline 12 to 24 months. Existing operations ramp up. Previously marginal deposits become economically viable. New projects accelerate development. Industrial users optimize consumption. Material substitution where technically feasible. Product redesign to reduce material intensity. This happens gradually as engineering teams adjust to new cost structures. Price-driven demand destruction. Prices rise until marginal demand becomes uneconomical. Projects get postponed. Applications get abandoned. The market clears through elimination. Reality? Probably a combination. Some supply expansion, some substitution innovation, some demand reduction. The market finds equilibrium through multiple adjustment mechanisms simultaneously. What does this mean practically? If you're in industries consuming these materials, extended delivery windows mean extended planning horizons. Your 6-week procurement cycle just became 12 to 14 weeks. Adjust inventory strategy accordingly. If you're trying to understand commodity markets, benchmark prices and physical availability are not the same thing. A quoted reference price doesn't guarantee you can obtain material at that price, in the quantity you need, in the time frame you need it. If you're watching markets generally, price charts alone miss critical structural information. Delivery window expansion is a leading indicator. It signals supply chain stress weeks or months before it shows up in pricing. Everything outlined here is verifiable. Delivery window quotes. Call refineries directly. Premium spreads. Request quotes for physical product. Trade flows. Customs databases publish this data with a lag, but it's accessible. I'm not forecasting price direction. That depends on production response speed, demand trajectory, macroeconomic conditions. Too many variables to predict with precision. What I am showing you is how to read supply chain signals most market participants ignore. When physical market mechanics diverge from paper market pricing, that gap contains information. Understanding it gives you better context than price movements alone. Here's what to watch going forward. Delivery window trends. Are they stabilizing, extending further, or compressing? Physical premium spreads. Are they widening, narrowing, or holding steady? Monitored inventory levels. Are stocks rebuilding, continuing to decline, or plateauing? Trade flow direction and volume. Is the geographic shift continuing, reversing, or stabilizing? Those 4 data points tell you whether this is resolving, intensifying, or reaching equilibrium, and they're all publicly trackable. No proprietary data required. This situation illustrates a broader principle in commodity markets. Financial pricing and physical reality operate on different timeframes. Paper markets react instantly to information. Physical supply chains move slowly. When those 2 layers disconnect, you get exactly what we're seeing now. Reference prices that don't reflect actual availability. Premiums that signal scarcity. Delivery windows that reveal constraint. The sophisticated participants, they're watching the physical layer, because that's where reality lives. Let me tie this together. Delivery windows doubled. Physical premiums increased 40 to 60%. Benchmark prices moved much less. Trade flows show metal moving from west to east. Monitored inventories declined 18%. That's not opinion, that's documented data. The interpretation is supply chains are adjusting to demand composition change. The adjustment creates temporary physical market tightness. That tightness shows up in delivery windows and premiums before it shows up in benchmark pricing. How long does it last? Depends on supply response speed, which depends on capital allocation, regulatory timelines, and technical constraints. 12 to 24 months is typical for this type of adjustment. If you want more analysis like this, structural breakdowns of how commodity markets actually function beneath the headline narratives, there's more on the channel. Thanks for watching.